Welcome to Course 16 of the MaxLife Commercial Academy. I'm Ryan Solberg, real estate broker with MaxLife Commercial here in Central Florida, license number 3354351. In this course, we're diving into one of the most diverse and opportunity-rich sectors of commercial real estate, retail and specialty properties. We're talking car washes, quick service restaurants, drive-through coffee, medical office buildings, auto parts stores, and sale-leaseback structures. Whether you're a passive NNN investor or an active buyer looking to add value, specialty retail offers a wide range of entry points and yield profiles. Let's get into it. Retail is not a monolith. When investors say retail is dying, they're usually talking about department stores in dying malls. What we're covering in this course is the exact opposite. Experiential, essential, or operationally intensive retail that e-commerce cannot displace. A car wash cannot be clicked. A drive-through burger cannot be delivered the same way. A dentist visit cannot be scheduled online and shipped to your door. Each of these property types has a distinct investment thesis. Strip retail and grocery anchored centers are income plays with value add potential. Car washes, QSR, and medical office sit firmly in the NNN and net lease universe with predictable cash flow. Sale-leasebacks are a sourcing and structuring play. You're solving a business owner's capital problem and buying a well-located property in the process. Cap rates across this sector range roughly from 4.5% for prime QSR ground leases up to 8.5% for value-add strip retail with vacancy. Your job as an investor is to match the risk profile and the management intensity to your own goals. Multi-tenant strip retail is where a lot of investors cut their teeth in commercial real estate, and for good reason. The fundamentals are straightforward, even if the execution requires attention to detail. At the core, you are underwriting two very different stories depending on occupancy at acquisition. A stabilized strip center is priced on its current income. You're buying a stream of rent checks, and your underwriting focuses on lease quality, tenant creditworthiness, remaining lease terms, and whether the in-place rents are at, below, or above market. Lease expiration clustering is your biggest risk. If three tenants all roll in the same year, you have concentration risk. A value add strip is priced on a blend of current income and the investor's projection of stabilized income after lease up. The gap between where the property is today and where it can be stabilized is where the profit lives. You're underwriting your leasing assumptions. What rents will you achieve? How long will it take to fill vacant space? What are your tenant improvement and leasing commission costs? The key formula here is simple. Multiply the stabilized NOI you expect to achieve by the cap rate you expect the market to value it at when you sell, and subtract your all-in cost. That spread is your value creation. At MaxLife Commercial, we run both sides of this analysis on every strip deal, and we're happy to walk you through live deals. Reach us at 321-586-2121. Grocery-anchored shopping centers have been the most resilient retail format through every economic cycle, and the reason is simple. People need groceries every week regardless of what the economy is doing. The anchor grocer drives traffic to the entire center, and that traffic is what makes the inline spaces valuable. But not all grocery anchors are created equal. In Florida, Publix dominates the market and commands some of the lowest cap rates in the grocery-anchored sector because of their fortress-like market position and consistent sales volumes. When you're underwriting a grocery-anchored center, you need to understand four things. First, the anchor's health. Look at their sales per square foot, their lease term, and whether they own their box or lease it. Second, the inline tenant mix. Service and food tenants are stickier than retail tenants. Third, the pad sites. Those out parcels to Starbucks, McDonald's, or Chase Bank often carry the lowest cap rates on the property and significantly boost overall value. And fourth, and this is the one that can blow up a deal post-closing, co-tenancy clauses in the inline leases. If the anchor goes dark, those clauses may allow your inline tenants to pay reduced rent or even terminate. We have seen deals where an anchor closure dropped the stabilized NOI by 30% almost instantly because of co-tenancy triggers. Read every lease before you close. Car washes have become one of the hottest NNN asset classes of the last 5 years, and the reason is the membership model. When Mr. Car Wash and similar operators converted from transactional per wash pricing to unlimited monthly memberships, they essentially transformed a weather-sensitive cyclical business into a subscription business with predictable recurring revenue. That shift made car washes dramatically more valuable as investment properties and dramatically more attractive to institutional capital. As an investor, you have two entry points. You can buy a car wash as an operating business. You own the real estate and the business. You hire an operator or operate it yourself, and you capture the full EBITDA. Express tunnel car washes at scale run 60 to 70% EBITDA margins, which is exceptional for any real estate adjacent business. Or you can buy a car wash as a passive NNN investment. The operator leases the property from you on a long-term net lease. You collect rent and have no operational involvement. The major national operators like Mr. Car Wash trade at cap rates in the low to mid fives. Regional operators trade slightly higher based on their credit profile. From a site selection standpoint, car washes want high traffic counts, at least 25,000 vehicles per day, high visibility corners, and proximity to other daily needs retail. If you're evaluating an operating car wash, the membership penetration rate is the single most important metric. A wash with 40% or more of volume on unlimited plans is a fundamentally different and more valuable business than one running primarily on transactional washes. Quick service restaurants and drive-through retail represent one of the most liquid segments of the NNN market. These properties trade constantly. They're well understood by buyers and lenders, and the underlying business models are among the most durable in all of retail. But the single most important underwriting variable is the lease guarantor, not the brand name on the building. A McDonald's location guaranteed by McDonald's Corporation is a fundamentally different investment than a McDonald's location guaranteed by a franchisee with 5 locations. Both carry the golden arches, but the credit behind the rent check is completely different. When evaluating a franchise-operated QSR, you need to pull the guarantor's financials, their net worth, their other locations, their brand, and how many units they operate. A large multi-unit franchisee operating 50 Taco Bell locations is far more creditworthy than a 2-unit operator. Medical office buildings occupy a similarly resilient part of the retail spectrum. Healthcare is not discretionary. Patients come back on a regular schedule, and the nature of medical buildouts makes tenants extremely reluctant to relocate. If you spend $150,000 fitting out an exam room suite with specialized plumbing, cabinetry, and medical gas, you are not moving unless you absolutely have to. That stickiness produces very low turnover, which is the foundation of MOB investment value. health system affiliated MOBs, where a hospital or large physician group has a master lease or credit guarantee, trade at institutional cap rates, and are actively sought by healthcare REITs. Auto parts stores like AutoZone and O'Reilly round out this group with absolute NNN structures and investment grade credit on 10 to 15-year leases. Sale-leasebacks are one of the most powerful deal structures in commercial real estate, precisely because they are off-market by nature. You're not competing with 20 buyers on a listed deal. You are solving a specific capital problem for a business owner who may not even know that selling their real estate and leasing it back is an option. Here's how it works. The business owner sells their real estate to an investor at fair market value, then simultaneously signs a long-term net lease to remain in occupancy as a tenant. The owner extracts capital from a previously illiquid asset. They can use that capital to expand their business, pay down debt, or diversify. And the investor acquires a well-located NNN property with an established tenant who has a vested interest in the success of the location. The sourcing approach is to target business owners who are real estate heavy relative to their operating capital needs. Auto dealerships, car washes, dental practices, veterinary clinics, dry cleaners, and manufacturing companies are all common sale-leaseback candidates. The 5 green checks on your screen represent what a healthy sale-leaseback candidate looks like. Profitable business, willing to sign a long NNN lease, strong location. The red flags are equally important. If the proposed rent would consume more than 15% of the business's gross revenue, you have a rent coverage problem that will likely result in default. If the business is declining, you're just buying the problem on a delayed schedule. At MaxLife Commercial, we source and structure sale-leaseback deals for both buyers and sellers. If you own your building and have wondered whether this structure makes sense for you, give us a call at 321-586-2121. We can run the numbers confidentially. That wraps up Course 16, Retail and Specialty Properties. You now have the frameworks to underwrite car washes, QSR ground leases, medical office buildings, strip retail, and sale-leaseback structures. These are some of the most sought-after NNN assets in the market, and understanding their nuances puts you well ahead of the average buyer. In our next course, we'll shift into office and industrial flex properties, a sector with its own distinct lease structures, tenant profiles, and value-add opportunities. I'm Ryan Solberg, broker at MaxLife Commercial, license number 3354351. If any of the deal types we covered today are relevant to something you're working on right now, don't hesitate to reach out directly. You can call us at 321-586-2121 or visit maxlifedevelopment.com/academy to explore all our courses and resources. Thanks for investing your time in the Academy. We'll see you in the next one.